Okay, so today I wanted to talk about risk parity portfolio allocation. This is kind of a continuation of the last segment that we did where we were talking about modern portfolio theory, the idea of finding weights that sort of suit you as an investor. There's so many different methods, so many different techniques that you can use to figure out like how to diversify a portfolio. And this is, I think, a very cool method that I'm excited to talk about. We're going to be talking about this again next week. The next week one is going to be a little bit heavier, but I think this still has some very cool tidbits and kind of talking about risk parity, introducing what it is, and all that. Yeah.
Yep.
Cool. Okay. So, as I said, last week, or last segment that we did, we just talked about modern portfolio theory as the sort of approach for diversifying a portfolio that uses mean variance optimization. Went into that in a lot of hairy detail, which was fun. But we're using this optimization method to estimate the portfolio weights for a target level of risk, really maximizing the expected return within this framework for a given level of risk. That was pretty complicated. This is, I think, a little bit easier to understand sort of what's going on. And again, the heavier segment is going to be next week. But today I wanted to sort of discuss what risk parity is. It's really this idea of allocating risk rather than allocating capital. It approaches this process of diversification and portfolio allocation from a different perspective that I think is really interesting. And hopefully we'll get a little intuition around that. Background. So portfolio allocation strategies, we've talked about them many times. They typically focus on allocations of capital. And we really want to find what capital allocations are most likely to give us a desired level of risk, reward, and diversification. So suppose, right, we got our moderate growth 60/40 portfolio. Here, I'm going to look at an example with some actual stocks and some ETFs. We're going to do 60% stocks and then 40% bonds and metals for diversification. So it's kind of a 60/40 hybrid portfolio. But again, your kind of classic moderate growth portfolio. So just to keep things simple, let's just say our 60/40 portfolio contains SPY, QQQ, Apple, TLT, and GLD. So we kind of have our 40% bonds and metals and then our 60% stocks and market indices. So in this example, each asset has equal capital distributions, right? So each asset of these 5 assets makes up 20% of our portfolio. And we can see those capital allocations in this chart in red. So we can see they all have the same capital allocations. But when we look at these stock returns from 2015 to 2023, each of these assets actually contribute different levels of risk to the portfolio. So risk contributions are not exactly the same as volatility. It's a little bit different. This portfolio during this backtest period has an overall volatility of 13.7% during this time frame, right? And what we can see in the white is the risk contributions for each of these assets allocated at 20%. So we can see that Apple contributes about 5% of that 13.7% volatility. I'm sorry, that risk, right? 5% of that comes from Apple. And then about 4% of that comes from the NASDAQ, which we would expect, right? Apple's a little bit more volatile than the NASDAQ. And then we have SPY, and then we see very small contributions from TLT and GLD because they're not very volatile assets. So our capital allocations are the same. We got 20% across these different assets, but our risk contributions are very different because Apple is going to contribute much more risk to the portfolio, to that 13.7% compared to GLD or TLT, for example. What a risk parity portfolio aims to do is allocate risk rather than allocating capital. And what we're trying to do generally with a risk parity portfolio is determine the weights that will allow each asset to contribute approximately the same levels of risk to the portfolio overall. So this is an example of a risk parity portfolio or risk parity weights with that previous example that we were using. So we still have SPY, we still have QQQ, Apple, TLT, and GLD. And when we look at the red bars, those are our risk parity portfolio weights, we can see that the allocations actually to TLT and GLD are higher. We can see that we're allocating, a bit to SPY, a bit less to QQQ, and a bit less to Apple, right? Because we're trying to allocate sort of less to these more volatile assets. So they all contribute about the same level of risk. So in this risk parity portfolio from 2005 to 2023, we can see that has about 10% portfolio volatility. And each component, each of those 5 components contributes about 2% to that, which kind of makes sense, right? It changes a little bit, but when we look at those risk contributions with these new weights, we can see that they all kind of contribute about the same amount of risk, at least during this backtest period, to the portfolio. That's what we're trying to do with risk parity. Okay. So, when you do an actual risk parity, when you're actually trying to determine those weights, the methodology is pretty complex. It's a numerical optimization problem, and we're going to dive into that more next week. But what's cool about risk parity is that there is also a naive approach that kind of can be used to approximate risk parity weights using a pretty simple back of the envelope calculation. So I thought it'd be cool to introduce risk parity using this back of the envelope calculation. It is an approximation. I'll show you the results in a little bit. It kind of gets us closer to true risk parity, but it's obviously not going to work as well compared to the full-blown risk parity, which again, we're going to dive into next week. Okay. Yeah.
Yep.
And again, full-blown risk parity is going to be much more accurate in terms of getting us to this chart, right? So this is with full-blown risk parity, where each asset contributes about the same amount of risk to the portfolio. And that is a pretty complex process, but I think the math is cool, so I want to dive into it next week. We'll also show some online tools that will do that calculation. But for now, I thought it'd be cool to talk about the naive approach, which gets us a little bit closer to that. Although obviously it's an approximation, it's a back of the envelope calculation, so it's not going to work as well as true risk parity. Okay, so a naive risk parity portfolio allocation, it's sometimes also called inverse volatility weighting. It's going to give higher weighting to lower volatility assets and vice versa. And that way, the risk contribution across these different portfolio elements is going to be a little bit closer to even, which is, again, what we're trying to achieve with this risk parity. We're not thinking so much about capital allocation, we're thinking a bit more about risk allocation. And if we want each asset, in our example, to contribute approximately the same amounts of risk, we'd want to put a lot more weighting on these lower volatility assets and, a little bit less weighting on these higher volatility assets. The actual approximation, again, it's back of the envelope calculations, actually pretty easy. We'll go through a numerical example in a second. But for N assets, the weighting for each asset I is given by this equation. We're really just taking for each asset. So for SPY, for example, we're taking 1 over the volatility of SPY, and then we're dividing that by the sum of 1 over the volatility for each asset in the portfolio. So 5 in the example that we were looking at before is N. And that's how you can approximate the risk parity weights for each component. So let's look at an example. Right, in our example portfolio, we had SPY, QQQ, Apple, TLT, and GLD from 2015 to the end of 2022, 2023. And so here we have our table of historical returns. So on, the 5th of January, 2015, SPY returned negative 1.81%, QQQ returned negative 1.47%, et cetera. So we have our returns table, for this backtest period that we're looking at. So what we do is we take these returns and we calculate the standard deviation of those returns. So for SPY, the standard deviation, so the volatility of those daily returns is about 1.14%. For QQQ, it's 1.40%. For Apple, it's 1.83%, and then et cetera. So we're just calculating standard deviation from our returns. You can also use implied volatility here instead of historical volatility, which is nice because you can usually just pull that off of a platform. You don't have to do the calculation. But if you want to calculate it yourself, you would take the historical returns and then calculate the standard deviation from that. And then bam, we have the historical volatility for each asset. So we have our historical returns standard deviation. And so now we would plug these, into the weights equation from the previous slide. So let's look at an example using SPY. So if we want to determine, or if we want to do this approximation for the risk parity weight for SPY, we take 1 over the standard deviation of returns for SPY, so 1 divided by 1.14%, and then we divide that by 1 over the standard deviation for each asset in the portfolio added together. So 1 divided by 1.14% plus 1 divided by 1.40%, right, for QQQ, 1 divided by 1.83% for Apple, and then so on. And if we actually run this calculation, our risk parity weight for SPY in our portfolio is about 20%. So what this approximation tells us is that for a risk parity portfolio allocation, SPY's allocation should be about 20%. If you used more assets, you would just kind of plug them in. But hopefully that makes the math make a little bit more sense looking at an actual real world example. We would then repeat this for all of our different portfolio assets. So repeat this 5 times for SPY, QQQ, Apple, Gold, TLT, all that. And this gives us our sort of naive risk parity weights for our portfolio. And as we expect, the lower volatility assets get a higher weighting. So those red bars again, this is saying about 25% we would allocate to GLD and TLT, and then about 28% for SPY, and then a bit closer to 15% for QQQ, and then about 12.5% for Apple. So we can see that the lower volatility assets are getting a higher weighting, and the higher volatility assets are getting a lower weighting, which is what we would expect. When we look at the risk contributions into that portfolio, so those white bars again, we can see that it brings us closer to risk parity, but it's not as, it doesn't work as well as true risk parity. But since this is a back of the envelope calculation, it does get us a little bit closer, which is nice. So when we compare all of these, so the true risk parity, obviously, like that's what our goal. And again, that's a more complex calculation that we'll get into next week. We'll also show some online tools that sort of do that calculation for you. But the naive risk parity is cool because compared to the equal weight portfolio that we had before, we can see it does bring us closer to each asset contributing sort of equal risk to the portfolio overall. And it's with a very simple calculation that's easy to do, that's easy to understand, and which is kind of a cool little trick. But if you're trying to achieve steady growth, or most likely, again, steady growth based on historical performance, which you got to always take with a grain of salt, this is kind of a quick and dirty way to do that, using at least one approach. Something that's cool about modern portfolio theory, even though it is, as we talked about last week, it's pretty complicated. It's pretty in-depth process, and it's typically a process you wouldn't do yourself as an investor. You would use a tool to kind of do that. But what's nice is that you can actually choose how much risk you want to take, and then see the expected returns trade-off when you're looking at the efficient frontier. You have a little bit more customization capacity when it comes to doing full-blown modern portfolio theory. Risk parity portfolio allocation, it kind of doesn't really care about expected returns. And we obviously care about that as investors. But it is still a helpful tool in terms of having sort of more even risk distribution across the different assets in your portfolio. But it's a neat little concept, this concept of allocating risk rather than allocating capital. It's just a cool approach, in my opinion, to diversification. So to just kind of conclude, risk parity portfolio allocation focuses on the allocation of risk rather than the allocation of capital. And the goal is to have roughly each asset in the portfolio contribute the same degree of risk to the portfolio overall. And so while true risk parity is a complex optimization problem, there is a naive approach that can be used to kind of approximate these risk parity weights. It's a nice back in the envelope calculation, but certainly does not work as well, right, as proper risk parity. The whole concept being we're going to place more of an emphasis on lower volatility assets and less of an emphasis on higher volatility assets to sort of equalize risk contributions. Next week, we're going to dive into the math behind true risk parity, as well as show some online tools that can complete those calculations. I think the math is cool, so I want to dive into it. But typically, this is something that you would not do yourself. You would use, some kind of online tool or service to be able to do it. Anywho, Louise, thank you for sitting through that. I hope you enjoyed
No,
it.
thank you for that. Definitely, I really liked it. Something new, like always learning with you. It's amazing, Julia.